For the foundation layer, we will be discussing the basics of investment management. So, what is investment management? When we hear the word investment, most of us will probably think of profit, shares, and the most common one nowadays, forex. But investment is actually much broader than that. Investment management simply means process of planning, organizing, and managing a portfolio of assets to generate returns while managing risk. It also means professional management of financial assets and other investments such as stocks and bonds to achieve specific investment objectives. There are two main groups involved in investment. First is retail investor, second is institutional investor. Retail investor is everyday people who invest their money to grow wealth or achieve financial goals such as saving for retirement, buying a house, or paying for children's education. While institutional investor, these are large organizations that invest on behalf of others such as pension funds. In Malaysia, we have EPF for pension funds and insurance companies, mutual funds or unit trusts. These institutions are usually managed by professional fund managers.
Now, I will be explaining what is speculation. Speculation is a process of committing funds into one or more assets and betting to obtain a return. Speculation normally chooses securities based on intuition and rumors in the market. Only little analysis is done before the security is bought. Speculation can be divided into two, which are speculative company and speculative stock. Speculative companies are companies whose assets involve great risk but also has the possibility of great gain. For example, a company who is involved in oil exploration. Speculative stock, on the other hand, is a stock that possesses high probability of low or negative rates of return and low probability of normal or high returns. Next, what is gambling? Gambling is merely betting on an uncertain outcome and no analysis is made prior to buying the security. Most gamblers depend on chance and good luck. Gambling can be considered as a form of entertainment. Now, I will be explaining 5 differences between investment, speculation, and gambling. The first difference is its purpose. Investment is a way to earn income, while speculation is a way to earn income and as a form of entertainment, and gambling is more on entertainment. The second difference is time horizon. Investment is for long term, speculation is for short term, and gambling is for very short time period. The third difference is investment decision. Investment is made based on careful analysis, while speculation is made based on rumors, intuition, or simple market analysis, while gambling is made based on luck. The fourth difference is risk assumed. For investment, it is low to moderate risk to low to moderate return. For speculation, it is moderate to high risk to moderate to high return. And for gambling, it is high risk, high return. For the fifth and final difference, it is income expectation. For investment, it is moderate capital appreciation. And for gambling and speculation, they are both for rapid capital appreciation.
Everyone invests for different reasons, but basically it's either for personal goals or financial goals. Personal goals are things we want to achieve in our own life, such as saving for retirement, buying a house, or preparing for children's education. These goals are more long-term and focus on our future lifestyle. But financial goals are goals that help our money grow. This includes things like earning capital appreciation, getting regular income from investments, building up our wealth over time, and making sure we have enough liquidity, which means asset that is easy to convert into cash.
Building wealth is like building a strong building. The foundation is our basic knowledge and planning. The middle layer from Chapter 2 focuses on choosing the right investment asset and managing risk wisely. This part helps keep our financial structure strong and safe. Today, we will explain this important middle layer. First, we have financial assets. These are not physical items but investment we buy from companies to support their project. Number 1, securities. Common stock means we own a part of a company. They can give a high returns but will also come with the high risk. Next, bonds and treasury bills make us lenders to the company or government. They give steady income and are safer compared to stocks. For regular investors, we have unit trust funds. These combine money from many people and managed by the professionals. Since the money is spread across many investments, the risk is lower. This makes unit trust a lower risk option. Lastly, we have derivatives like options and futures. Their value depends on other assets such as shares and commodities. They can give very high returns, but they are very risky and suitable only for experienced investors.
Now, for the mortar that holds our building together, risk management. The key takeaway from Chapter 2 is that not all risk is created equal. We classify risk into 2 critical types, systematic risk and unsystematic risk. Systematic risk is an uncontrollable and external risk that affects the entire market, like a recession or inflation. Since it affects all securities, you cannot diversify it away, and our defense here must be strategic hedging. For instance, holding real asset like gold can hedge against the market-wide threat of inflation risk. Next, unsystematic risk. This is a unique internal risk that tied to a specific company, such as management failure or labor strike. The great news is this risk can be eliminated. The solution is the classic principle of diversification. Don't put our children in a one basket. By spreading investment across different companies and sectors, can mitigate the impact of failure in a single area. In conclusion, the middle layer of wealth creation is defined by duality, the strategic choice of asset, and the mastery of risk classification. By understanding that we must strategically hedge against systematic risk and utilize diversification to eliminate the unsystematic risk, we ensure our wealth structure is solid, resilient, and steady for long-term growth.
What is security market? Security markets are financial instruments traded in the market. For example, stocks, shares, notes, debentures, and bonds. Security market is also a place where these instruments are traded, like stock market and derivative market. Company issue stock to raise fund for their business, and investors trade stock to earn capital gains or receive dividend in the future.
So the first market are primary market. What is primary market? Primary market is where the company or government issue new security to the public to raise fund. There are 4 types of instrument in primary market. The first one being initial public offering. It is where a first-time company issue the security to the public. The second one is sales share to employees, where it is a place where companies sell new shares to their own employees. The third one is private placement, where companies sell new share directly to the selected investor, usually institution. And the last one is right offering, where companies sell new shares to existing shareholders.
So IPO is where a company issues shares to the public. The company, also known as capital raiser, appoints an investment bank to help issue new share. Then the investment bank will act as a middleman and discuss IPO process with the company. The company, however, must get an approval from the Security Commission before issuing their shares, and the investment bank will form an underwriting syndicate to sell shares. Underwriter also guarantees to buy unsold shares, which ensures full subscription of shares. Next one is sales shares to employees. Sales shares to employees means company will sell new shares to their employee at a discount. The purpose of this instrument is to encourage employee ownership of the company equity. So employee who buys ESOS shares cannot sell them for a certain period. The third instrument is right offering. It happens when the company sells new shares to existing shareholders. It is also based on preemptive right, allowing shareholders to maintain their ownership percentage. Shares are also offered at a lower price than market value, and shareholders who do not want them can sell their right in the secondary market. It is usually unwritten, where underwriter buys remaining unsubscribed shares and use a provision allotment letter to notify shareholders. Lastly, shareholders must also act within the given period of time. A few advantages for these instruments is shareholders can maintain their ownership percentage in the company. The next one is the company can sell their new shares at a discounted price, making it cheaper for shareholders. And lastly, shareholders who doesn't want the new shares can sell the rights in the stock market for profit. Advantages include some shareholders may not be able to subscribe to the new rights, such as lack of funds. The right price may be unattractive if the market condition causes the share price to fall below the offer price, and dilution of ownership happens if existing shareholders do not buy the rights. The last one is private placement. Private placement is where the company sells new shares directly to the selected investors, usually institutions. There's also no underwriter getting involved, and investor cannot sell their share for a specific period. There's few advantages for this instrument. The first one being, it is fast one. The company can raise funds quickly. It has lower cost, no underwriting fee, and flexible financing, where company deals directly with a group of investors. Whereby its disadvantages are it has lower offer price than public offering, selling restrictions where investor cannot sell shares within a set of time. Under this chapter, we will be talking about 2 regulatory bodies. The first one is Bursa Malaysia. It was established in 1930 and originally part of Singapore Stockbrokers Association in 1973. However, after Malaysian-Singapore currency separation, the Stock Exchange of Malaysia and Singapore split into 2, which is Kuala Lumpur Stock Exchange and Stock Exchange of Singapore. In 2004, the KLSE was renamed Bursa Malaysia. This regulatory body also has its own function. For example, it acts as a regulatory to ensure security transaction run smoothly and properly. It provides rules for Bursa securities covering trading, business conduct, settlement, and others. It conducts a market surveillance for the security market. It enforces rules and policy to protect investors and members from unethical and illegal practices. And lastly, it promotes public interest and confidence in the security market. Additional information that I might add is Malaysian Central Depository, CDS. In 1990, Bursa Malaysia was established as Malaysian Central Depository Sdn Bhd, MCD. CDS operates under the Security Industry Central Depositories Act 1991 and handles clearing and settlement for share transaction. It also enables electronic transfer of security between buyers and sellers. Next regulatory bodies is
Security Commission Malaysia. SC was established on 1st March 1993. It acts as the main regulatory body for Malaysian entire capital market and operates under the Security Commission Act 1993. As for the roles and function, SC supervises stock exchanges, clearing houses, central depositories, and regulates all activities related to the capital market. SC also serves as the authority to register prospectus for companies issuing new shares to the public. They also regulates mergers and takeovers to ensure fairness and transparency, ensures the capital market is conducted in a proper, orderly and fair manner, supervise licensed persons like investment advisor or fund manager, and lastly, they also approve license for individuals and institution dealings in security.
Now, let's talk about the differences between main and is market. The main market is the merged platform between the former main board and the second board. It is designed for established companies that want to raise funds. Companies listed here does not need to work with a sponsor. The is market, on the other hand, was transformed from the domestic market. It serves as an alternative platform for companies from any sector to raise funds. Unlike the main market, companies on the is market must work with a sponsor who assesses their suitability for listing and must continue supporting them for at least 3 years after listing. For IPO pricing, the main market requires a minimum share price of 50 cents for an initial public offering. Meanwhile, the is market does not impose any minimum IPO price requirement. Reason for listing. The primary reason for a company to be listed in Bursa Malaysia is to raise capital. Company can issue new shares to existing shareholders to increase their fund. For investors, it will help them to increase their fund. The securities markets, which have liquidity market here, make the investors able to sell back their share anytime. The second one is expansion. Bursa Malaysia is a place to expand their company. Company gets the publicity for all activities from Bursa Malaysia. Thus, it helps the company to be recognized by investors. It is easy for the company to expand the business internationally. The third one is build confidence. Listed company will be able to increase the level of confidence of investors towards their company. It is because to be listed, a company needs to fulfill some requirements from Bursa Malaysia. The last one is higher profile. To be listed, a company must maintain a strong reputation to stay listed. This will help attract more investors and enhances company profile. Now, let's talk about functions of Bursa Malaysia. Central market for trading shares. It provides a platform for buying and selling securities, giving investors liquidity and opportunities for capital gain and dividends. Second one is efficient trading facilities. It offers systems like the Central Depository System (CDS) for electronic shares transactions. Furthermore, clearing and settlement services. It uses FDSS and ISS to ensure smooth, secure, and low-risk settlement of trades. Next, we have real-time information. It supplies market data to help investors make informed decisions. And last but not least, investor protection. It enforces rules and policies and provides a compensation fund to protect investors from losses due to fraud and misconduct. So, we have 3 types of transaction. The first one is cash transaction. This kind of transaction is bound entirely from investors in purchasing the securities. It means that the investors paid in the transaction in fully cash. The second one is margin trading. It is partial between paid in cash and the balance come from cash borrowed from broker pledged to the securities as collateral. It gives advantage to the investors to buy more stocks. The advantages for margin trading is the investor will have to suffer paying the interest to the broker. The third one is contra transaction. This transaction occurs when the client, which is the investor, make the buy and sell order at the same time. Purchased shares are sold before the investors make the payment. This kind of transaction settle either broker pays to the client if the transactions gain profit or the client pays the broker if the transaction is lost. Next, I will explain the 2 main types of orders used in the stock market. The first one is market order. A market order is the simplest type of order. It means buying or selling a stock immediately at the best price available in the market. When we place a buy market order, the broker will try to get the lowest possible price. When we place a sell market order, the broker will try to get the highest possible price. The second one is limit order. A limit order allows us to set a specific price. The order will only be executed if the market price reaches that level. For example, a buy limit order means the broker will only buy at the limit price or lower. A sell limit order means the broker will only sell at the limit price or higher. This gives investors more control over the price that they want. So, in summary, market orders focus on speed, while limit orders focus on price control.